Your roadmap to the latest in auto. Welcome to Highway Herald, where every twist explores the gears of global economics. In April 2025, President Trump unleashed sweeping tariffs that sent shockwaves from Wall Street to Shanghai. Markets tumbled, bond yields surged, and confidence in U.S. financial leadership took a hit. Billions vanished from global indices almost overnight. But this isn't just a political play, it's a full-throttle disruption of economic norms. Buckle up as we break down the mechanics behind one of the most impactful financial shakeups of the decade. Recalibrating global markets, Trump's tariff shock and investor backlash. April 2025 didn't ease in. It skidded onto the scene with the screech of economic rubber. President Trump unleashed a bold protectionist maneuver, a sweeping 10% tariff slapped on all imports, with punishing 145% duties targeting Chinese electric vehicles, tech components, and steel. Dubbed a tariff tsunami, the move jolted markets worldwide, setting off financial aftershocks that rivaled a global recession. In mere days, the MSCI All-Country World Index hemorrhaged over $5 trillion in value. U.S. stocks stumbled and bond markets flipped. The 10-year Treasury yield surged to 4.592%, its highest mark since early 2024. Normally, a crisis sends investors racing into U.S. Treasuries for safety. But this time, they ran the other way. Why? Confidence slammed into a wall. Trump's erratic mix of stimulus and shock policy unnerved global investors. Treasuries, once considered untouchable, suddenly felt unstable. Hedge funds hit with margin calls triggered widespread liquidations. The infamous bond vigilantes returned, punishing what they saw as fiscal recklessness. The US dollar lost ground to both the euro and yen. Gold wobbled, then rebounded. In that moment, one thing was undeniable. The foundation of global finance was showing signs of serious stress. And that stress only intensified in the next chapter, as investors started questioning the bedrock of safety itself, US Treasuries. Cracking the foundation, Treasuries lose their safe haven status. The speed of the sell-off was jaw-dropping. Treasury yields didn't just climb, they launched across the entire curve. The 10-year yield shot up to 4.592%, while the 30-year hovered dangerously close to 4.8%. Even short-term notes weren't spared. This level of synchronized dumping usually screams external crisis. But this time? No war, no collapse. Just a global market losing faith in America's fiscal steering. Let's talk about scale. The U.S. is carrying over $33 trillion in federal debt, with $7.5 trillion held by foreign creditors. For years, this global network of buyers helped keep U.S. borrowing costs down. But as inflation fears flare and Washington's economic signals shift erratically, that trust is starting to peel away. Major players like Europe and Japan began rebalancing toward domestic bonds. Hedge funds, hit by margin calls, launched into a full-on Treasury liquidation. And those infamous bond vigilantes? They showed up, loud and clear. Their message, Washington, tighten your belts, or brace for impact. Higher yields mean costlier borrowing, deeper deficits, and shaken investor confidence. It's a dangerous loop. Without a course correction, America's own debt could become its most powerful economic liability. Before we delve deeper, we'd appreciate it if you could subscribe to Highway Herald. Your support fuels our passion to deliver high-octane updates on vehicles, policies, and the powerful connections in between. Now let's shift our focus east, where China's quiet calculations could change everything. China's calculated drift, managing leverage in the debt arena. Now cue China, the second biggest foreign holder of U.S. debt, gripping over $760 billion in treasuries. With Trump's tariffs ratcheting up the tension, Beijing found itself staring down a difficult corner. Retaliate by dumping treasuries and risk crashing its own suspension, or ease off and try to maintain stability. Historically, China's U.S. bond holdings have been more than just investments. They're tools to control the yuan and ensure export competitiveness. But the current geopolitical headwinds have sparked speculation. Will China unload treasuries to apply pressure? Some analysts believe a slow, silent shift is already underway, reallocating toward German bunds or euro-denominated securities. A signal flare to Washington without igniting a market blaze. Others warn that any large-scale sell-off would backfire. It would crash bond prices and hurt China's own portfolio, while boosting the yuan and throttling exports. It's a classic high-speed balancing act. Any drastic move from Beijing could rattle markets even harder. US borrowing costs would spike, global equities could tumble, and the financial sector would grip tight for impact. For now, China's playing it cool, but it's got one hand near the e-brake. But China's not the only heavyweight behind the wheel. Japan, too, is taking a stance, though one that leans on legacy and long-term calm. Japan's balanced gear shift, prioritizing stability over retaliation. As of early 2025, Japan holds a powerful $1.08 trillion stake in U.S. Treasury securities. But rather than use that leverage as a weapon, Tokyo has opted for calm over confrontation. Even with new U.S. tariffs hitting Japanese exports, Finance Minister Katsunobu Kato made it clear. Japan's bond holdings are reserved for currency management, not geopolitical power plays. This deliberate restraint underscores Japan's long-game strategy: maintain market stability, avoid financial shocks, and keep confidence intact. In a global climate where economic tools are increasingly politicized, Japan's approach is refreshingly steady. It's not just about preserving its decades-long alliance with the US, but also about reassuring global investors that Japan won't add fuel to the fire. That said, challenges still loom. The new tariffs threaten Japan's export-driven economy, and global financial volatility has officials monitoring every dial and gauge. But instead of swerving wildly, Japan is choosing calculated control, guiding its fiscal course with precision. In doing so, Japan may be offering a masterclass in economic composure. While others race toward reaction, Tokyo is proving that sometimes stability is the power move. Yet, as both China and Japan hit the brakes, the rest of the world is still feeling the financial whiplash from this American-made shockwave. Global market whiplash, when the world feels the shocks. When U.S. Treasuries start to shake, the entire global economy feels the aftershock. As the backbone of the international financial system, any jolt in America's debt markets sends shockwaves through capital flows, interest rates, and investor confidence. In 2025, those once subtle ripples have turned into powerful waves. Trump's aggressive tariff escalation injected fresh uncertainty into the markets, triggering a dramatic sell-off in U.S. bonds. Suddenly, Treasuries, long seen as a financial fortress, looked more like a risk than a refuge. That shift alone raises America's borrowing costs and adds pressure to an already ballooning federal deficit. But the implications go far deeper. Investors across the globe are watching how giants like China and Japan manage their massive U.S. bond holdings. Any shift in their strategy could rearrange global capital flows, strain diplomatic ties, and create brand new economic stress points. This episode also reminds us just how tightly linked the global economy is. A tariff in Washington can spike yields in Tokyo. A bond move in Beijing can spark panic in Paris. In this connected world, financial stability demands more than solo decisions. It requires coordination, communication, and global foresight. So where does all this leave us? Right at the heart of a financial power play that could define the next era. Final gear, the double-edged blade of economic power. What's unfolding in the U.S. Treasury market is far more than a temporary shakeup. It's a critical stress test for the global financial system. The U.S. may have kicked things off with sweeping tariffs, but it now faces the aftershocks: wavering investor confidence and growing skepticism about its fiscal leadership. With China and Japan holding over $1.8 trillion in U.S. bonds, any shift in their strategy could send shockwaves through global markets. Selling those bonds might pressure the U.S., but it's a risky move. It could also destabilize China and Japan's own economies by triggering currency fluctuations and reduced export competitiveness. It's a precarious dance, like redlining a high-performance engine, where one misstep could cause everything to overheat. Is this a game of economic chicken, or just leverage for a better trade deal? We'd love to hear your take. Will China or Japan act, or hold the line? Can the U.S. weather the storm it stirred up? Comment below, and don't forget to subscribe to Highway Herald for more high-octane insights into the world of global auto and economic power. Thanks for riding along. You can now check out any of the videos on the screen. There's more exciting and informative content waiting for you.